They did it. They actually did it. February 13th, 2026, 8:47 p.m. Eastern. I am staring at what remains of silver, down $10 per ounce in 48 hours, and I need you to understand something right now. This was not market forces. This was not profit-taking. This was a coordinated assault by the same institutions that have been bleeding out on short positions since late 2024, and what you just witnessed was the equivalent of a bank robbery where the criminals own the vault, write the laws, and control the cameras. Let me be absolutely clear before the algorithm buries this video and the fact-checkers crawl out to defend their Wall Street masters. This is not financial advice. This is a field report from an active war zone. This is pattern recognition. This is historical precedent playing out in real time while the financial media feeds you comfortable lies about healthy corrections and profit-taking. Do your own research if you still trust the people who have systematically stolen your purchasing power in 1971, again in 2008, again in 2020, and right now in 2026, while telling you inflation is transitory and everything is under control. Here is exactly what happened. 48 hours ago, silver was trading at $86 per ounce. Not 86 because fundamentals weakened. Not 86 because demand evaporated. $86 because the suppression mechanism that has held this market down for decades finally fractured. The COMEX warehouse inventory sat at 12-year lows. Shanghai premiums were running 8% over London spot prices. The Perth Mint started rationing deliveries to customers. Every single physical indicator in the real world was screaming one word: shortage. And the banks, the bullion banks with their massive short positions opened at $23 in late 2024, were trapped. They were underwater by $63 per ounce on an estimated 200 million ounces of net short exposure across the top 8 trading desks. Multiply that out, and you are looking at $12.6 billion in unrealized losses. That is not a line item they can bury in quarterly earnings. That is an extinction-level event for institutions operating on 30-to-1 leverage ratios. So they did what cornered predators always do. They attacked. Thursday morning, February 11th, 9:32 a.m. Eastern, a rumor hits the news wires. Russia is reportedly considering the sale of strategic silver reserves to fund Ukraine reconstruction efforts. No official source. No Kremlin confirmation. No government spokesperson on record. Just a single anonymous line on a wire service that gets instantly amplified by algorithmic trading systems programmed to react to keywords. Russia. Selling. Silver. Within 6 minutes, the price drops $3. Stop-loss orders start triggering across retail accounts. Traders who bought at $82 with $4 stops get automatically liquidated by their brokers. That forced selling creates more downward momentum. The algorithms see the velocity. They pile on with more sell orders. By noon Eastern Time, silver is at $79. By Thursday's close, $77. By Friday morning, $76. $10 in 48 hours. And the establishment media, without a shred of investigative curiosity, calls it profit-taking. Profit-taking. Let me show you what profit-taking looks like versus what a coordinated short-covering operation looks like, because the difference is written in the volume data, and they are counting on you not knowing how to read it. Pull up the volume statistics for Thursday, February 11th. Total COMEX silver futures volume. 412,000 contracts traded. Each contract represents 5,000 ounces. That is 2.06 billion ounces of paper silver changing hands in a single trading session in a market where the entire annual global mine supply is only 826 million ounces. You just traded 2.5 years of planetary production in one day. That is not investors taking profits. That is algorithmic warfare. That is institutional coordination. That is a planned operation. Now look deeper at the intraday volume distribution, because this is where the crime scene evidence becomes undeniable. The heaviest volume does not occur during the price decline. It hits at the bottom. Friday morning, February 13th, 10:47 a.m. to 11:19 a.m., a 32-minute window at $76 per ounce. 93,000 contracts trade in 32 minutes. That is the banks buying back their short positions. They engineered the panic. They triggered the avalanche of stop losses. They created the liquidity pool at the bottom. And then they covered their losing positions at a $10 discount to where they were facing liquidation 2 days earlier. They turned a $12.6 billion disaster into a $10.6 billion manageable loss. And they did it by stealing $10 per ounce from everyone who sold in fear at the lows. Let me take you inside the exact mechanics of how this operation was executed, because understanding the playbook is the only way to avoid being the victim next time. The setup begins weeks in advance. Late January 2026, silver is grinding steadily higher. $81, $83, $85. Every single dollar higher is costing the short sellers hundreds of millions in mark-to-market losses that have to be reported, that have to be margined, that create operational and reputational risk. But they cannot simply cover their shorts in a rising market. If they start aggressively buying, the price accelerates even faster. They need a catalyst. They need fear. They need a reason for the long positions to sell so they can buy without pushing the price vertical and making their problem worse. So they wait. They monitor geopolitical flashpoints. They watch the news wires for any headline that can be weaponized, any narrative that can be amplified. And on February 11th, they get their gift: an unverified, unsourced rumor about Russian strategic reserve sales. The truth of the rumor is irrelevant. The only thing that matters is whether the algorithms react to it. And they do. Here is the exact sequence. 9:32 a.m., the rumor drops on the wire. Price falls from $86 to $83 in 6 minutes. That initial violent move is purely algorithmic. High-frequency trading systems scanning news feeds see the keywords Russia, selling, silver, and execute pre-programmed sell orders. No human decision. No analysis. Just pattern-matching code executing at the speed of light. By 9:40 a.m., 8 minutes later, the first wave of retail stop losses triggers. These are the traders who bought at $82 with tight $4 stops designed to protect capital. Their brokers automatically liquidate the positions. That selling creates additional downward pressure. By 10:15 a.m., the second wave hits. These are momentum traders who bought the breakout above $80. They see the chart structure breaking down. They panic. They sell manually, adding human fear to the algorithmic cascade. Now you have genuine panic in the market. The technical levels are breaking. The narrative is spreading. By 11 a.m., large speculators start cutting positions. Hedge funds that were long silver as an inflation hedge decide the trade structure is compromised. They liquidate. By noon, silver is at $79 and the sell-off is self-sustaining. No more rumors needed. Just pure technical breakdown, forced liquidation, and cascading fear feeding on itself. But watch what happens at the bottom. $76. Friday morning, February 13th. The volume explodes. Not selling volume. Buying volume. The same banks that were short at $23 and drowning at $86 are now covering at $76. They manufactured a $10 flush to save themselves from a $63 catastrophic loss. They turned an existential crisis into a survivable wound. They flipped their position from net short to net long. And the financial media, acting as the public relations arm for institutional crime, calls it a healthy correction and tells you the bubble is deflating. This is not new. This is not innovative. This is the same playbook they have run every single time metals threaten to expose the fraud of the paper system. January 1980, silver hits $50 per ounce. The Hunt brothers are squeezing the market. The exchanges panic. They change the rules mid-game. They implement liquidation-only trading. You can sell your positions, but you cannot buy new ones. The price collapses from $50 to $10 in 8 weeks. The shorts cover. The system survives. The retail buyers are destroyed. Fast forward to March 2008. Silver is trading at $21. Bear Stearns collapses. The banks need emergency liquidity. They dump everything, including precious metals. Silver falls to $8 by October. The short positions that were opened at $18 get covered at $9. 50% profit on a crisis they helped create. 6 months later, silver is back at $28, but the banks already locked in their gains at the bottom and flipped to the long side for the recovery. Now look at March 2020. Silver at $18. Pandemic lockdowns hit. Margin calls cascade across the financial system. Banks sell metals to raise emergency cash. Silver drops to $12 in 2 weeks. The shorts cover. 6 months later, silver is back at $28 and testing the 2011 highs, but the institutions already repositioned. Same pattern, same sequence, same outcome. And now, February 2026, The identical playbook with a different geopolitical excuse. They manufactured the fear with an unverified rumor. They triggered the stop-loss cascade. They bought the panic at the lows. And next week, when silver is back at $82, they will be net long instead of net short. They will have flipped sides. They are not fighting the bull market anymore. They are riding it. But only after extracting $10 per ounce from everyone who sold at $76 in fear. I need field intelligence from you right now, and this is not about engagement metrics. This is about building a distributed surveillance network to track what is actually happening in the physical market while the paper market runs fake prices. Drop a comment and tell me what the premium is at your local bullion dealer today. What is the wait time for delivery? What is the spread between generic rounds and sovereign coins? Are dealers buying metal back from customers, or are they rationing sales? Because here is what I am seeing, and this is the tell that separates a genuine market sell-off from a paper raid. Wednesday, February 11th, before the raid began, the premium on American Silver Eagles was $4 over spot price. Today, Friday evening, February 13th, after a $10 price drop, the premium is $6.50 over spot. The premium on Canadian Maple Leafs went from $3.20 to $5.80. The premium on generic rounds went from $2.40 to $4.10. Read that again. The paper price dropped $10. The physical premium expanded by $2 to $3. The physical market is moving in the opposite direction of the paper market. When a real demand collapse happens, premiums compress. Dealers get flooded with inventory from sellers. Premiums drop. Wait times disappear. But when a paper raid happens, premiums expand because physical buyers see the discount and step in while paper traders panic out of their leverage positions. The divergence between paper and physical is the proof. This was not real selling. This was paper manipulation while the physical shortage intensified. Let me show you the mechanics of how the short covering operation actually functions, because this is not as simple as clicking a buy button. The COMEX futures market operates on margin, which means you do not need the full capital to control a position. You only need a fraction. When you short a silver contract, 5,000 ounces at $86, that is $430,000 in notional value. But the initial margin requirement is only around $21,000. You control $430,000 of exposure with $21,000 in capital. That is 20-to-1 leverage. It is extraordinary when the trade works in your favor. It is catastrophic when it moves against you. Now imagine you are a bullion bank. You shorted 200 million ounces at an average price of $23 back in late 2024 when everyone said metals were done, when the Fed was hawkish, when real yields were rising. That is 40,000 contracts. Your initial margin was $840 million. Manageable for an institution with a balance sheet in the hundreds of billions. But as silver rallies from $23 to $86, you start receiving margin calls. Every dollar the price rises requires additional variation margin to cover the growing unrealized loss. At $86, you are down $63 per ounce on 200 million ounces. $12.6 billion in unrealized losses. Your margin requirements have exploded. You are posting billions in additional collateral just to keep the position open, and every day silver stays at 86. You are bleeding carrying costs, opportunity costs, operational risk, and the reputational nightmare of this position showing up in a regulatory filing or a quarterly disclosure. They had three options. 1. Cover the short at $86 and lock in a $12.6 billion loss. Career ending, firm ending, not survivable. 2. Hold the position and hope silver collapsed on its own, an extremely risky bet that could have spiraled into forced liquidation if prices ran higher. 3. Engineer a sell-off, suppress the price, and cover lower. That is the option they chose. Using media access, algorithmic trading, and coordinated selling across desks and time zones, they manufactured panic. They planted the Russia rumor, triggered algorithms, and cascaded stop-losses. Then, at 76 instead of 86, they bought. $10 per ounce saved across 200 million ounces, $2 billion in damage control. The loss was still massive, but survivable, and the position flipped from terminal to future opportunity in one coordinated 48-hour operation. Let me connect this to the broader macro picture, because this raid did not happen in isolation. It unfolded inside a global monetary system that is actively breaking down. As of January 2026, the United States is carrying over $36 trillion in debt, with interest costs alone exceeding $1 trillion annually. The government is now borrowing just to service prior borrowing, which is not a policy choice, but a mathematical dead end. Default is inevitable, either openly or through currency debasement, which is default in slow motion. The Federal Reserve understands this trap. Rates cannot rise without detonating Treasury financing, and they cannot fall without reigniting inflation and eroding purchasing power. So policymakers are managing a controlled demolition, inflating the debt away slowly enough to avoid revolt, but fast enough to keep the system funded. In that environment, hard assets become the only rational hedge. Gold, silver, energy, and commodities cannot be created with a keystroke. That is why silver surged from the low 20s to the mid-80s, not because of industrial demand, but because of monetary demand. Investors are exiting paper claims and moving into physical assets. But the banks cannot allow that transition to happen too quickly. A vertical move in silver would expose the paper market and reveal that venues like the COMEX operate on a fractional reserve basis. So they manage the ascent. When silver jumped $18 in 2 weeks, the risk of a real short squeeze became too high. They ran a raid, pushed prices lower, flushed out leverage, and reset the chart. The proof was in the gold-to-silver ratio. Gold barely moved while silver was crushed. That is not a free market. That is intervention, designed to suppress the one asset threatening to expose the system. The establishment media ran cover for the entire operation without asking a single uncomfortable question. Bloomberg framed the move as profit-taking after a rapid rally. CNBC questioned whether a silver bubble was bursting. Reuters amplified an unnamed analyst claiming the Russia reserves rumor was credible. There was no pushback, no investigation into the suspicious volume at the exact lows, no explanation for why physical premiums were expanding while paper prices collapsed. This wasn't journalism. It was narrative enforcement. The information control system worked exactly as designed to keep the public from understanding what was happening. Now look at what the smart money actually did, because it was the opposite of what the media advised. While headlines warned investors to take profits and rotate back into paper assets, insiders were buying physical metal aggressively. On February 13th, silver on the Shanghai Futures Exchange traded at over a 9% premium to COMEX prices, the highest premium in more than a decade. Chinese buyers willingly paid far above the paper price to secure real metal. That isn't profit-taking. That's urgency. They understand the paper price is artificial and the physical shortage is real. The same pattern showed up elsewhere. The Perth Mint extended silver bar delivery times to as long as 12 weeks and imposed strict purchase limits. Rationing does not happen in a market where demand is collapsing. In the United States, Silver Eagle sales surged to their strongest February pace since the 2020 panic. Retail demand isn't fading, it's accelerating. Ordinary buyers see the paper raid for what it is, a temporary discount before the system breaks. Central banks are doing the same thing, just through gold instead of silver. They are converting paper claims into hard assets at the fastest pace in generations. And when central banks buy gold, institutions buy silver because it's cheaper, more volatile, and more leverage to the same monetary reality. Silver is accessible. Silver is visible. And that's why it must be controlled. But control doesn't change math. The debt is unpayable. The currency is being debased. The physical shortage is real. Paper selling can delay the move, but it cannot stop it. This wasn't the end. It was the shakeout before the breakout.